Okay, so thank you very much for logging on time and welcome to the Client Review Workshop. Now, as you probably heard from me many times, the Client Review Workshop was introduced, this is our third year I think of doing it, and it was really introduced to help us improve the review process. What we were finding was there was a huge amount of content that we needed to include in the client's review. And we were struggling to get all of that done. But what we were also finding, because we'd got one centralized investment approach for probably about 90% of our clients, we were repeating the same message time and time again. So by doing the client review workshop, this is in no ways a replacement for the advisor meeting, although some years you may find you don't need that advisor meeting, but it's not designed to replace it. It's just designed to allow us to give you much more information on what's going on with your investments, what's going on with the markets, what's going on in terms of financial planning opportunities. And then when you have that time with the one-to-one advisor meeting, you can focus in on what's unique to you. So it isn't in any way trying to replace that. It's just trying to make the process much more efficient. So let's dive into the client review workshop. And before I do dive into the content, I just wanted to have a look at this picture. Firstly, raise your hand if you see a duck. Excellent. So some of you see a duck. Raise your hand if you see a rabbit. Okay, somebody's seeing a rabbit. Raise your hand if you see both. Okay, interesting. So the whole point is, when I first saw this, I could see a duck, and my youngest daughter could see a duck, but I really struggled to see the rabbit. My wife and my eldest daughter, both of which are a lot more creative than I am, immediately saw the duck and the rabbit. So the only reason I start with this is when you're reading the news, or when you're looking into markets, or you're hearing the latest commentary about Brexit, it's what you see is not always what you really do see. So anyway, a little brief update on Efficient Portfolio before we dive into the workshop. We've grown a lot as a business over the last few years. In fact, our new business levels have been growing at 50% in 5 of the last 6 years, and we're on track to do that again for a 6th year. So that's been really very good growth for us. We're now up to a team of 20. Around 16 of us are based out of the Rutland office, and then we've also got a permanent London advisor as well, which I'll tell you more about later on. So we've been growing really well as a business, and obviously we'd like to thank you guys for your part in that. Now, we'll have sent you your client review pack by email, and it would be really helpful if you've got that open at the same time as going through the client review workshop, because it'll allow you to look at your version of the charts. And then what I'll do is I'll use charts with genuine data, and data that will go back 5 years, a little over 5 years, 5.5 years, back to January 2013, because that's when these portfolios were created. So if you've been invested for less than 3 years, really, the investment data that you'll be looking at in your own pack is less than meaningful. I mean, obviously you want to look at it and you want to see whether it's doing well or not. But really, investment data should only be looked at over 3 years or more for it to be relevant data. So what I'm going to be able to do today is also show you this 5.5 year data so that you can see how those portfolios have performed over a longer period. Now, within that review pack and in your Efficient Portfolio summary, you've got a number of pages. The first couple of pages look something like this. You've got one page on your investments. It'll list the platform, it'll list the type investment, whether it's an ISA or a PIP, your risk score, and the current value. It'll also tell you about what ISA allowance you've got left. The next page will then look at your pensions. You've got, again, all the same information listed here. We also highlight the platform and that you're using. With regards to the platform, we still predominantly use Praemium and WealthTime. WealthTime we use for probably the larger majority of our clients, but for different reasons, sometimes Praemium's better, sometimes WealthTime's better. At the moment, they're the 2 preferred platforms. There's a couple of instances where we have to use different platforms like Transact, but generally speaking, those are the best platforms out there. And so if you're in Praemium or Wealth Time, there shouldn't be any reason to move away from them at the moment. The reasons we put you in there in the first place still remain solid. You've then got a couple more pages that look like this, one with any protection, so life insurance and those sorts of things listed out. And then finally, the estate planning page, which is about wills, trusts, those sorts of things. So all of what we currently look after for you are listed on those pages and should give you a nice overview of what's there. So let's have a look at the markets that are out there at the moment, and because when we look forward, there always feels to be quite a bit of uncertainty. To start with, let's look backwards and let's say, well, okay, what have all the different areas been doing? Well, and this chart looks at over 2017, 2018 year to date, and just the last quarter. And these are all of the different assets that you could invest in. And your portfolios are in pretty much all of these asset classes, except in a lower risk portfolio, you wouldn't have global property, and commodities aren't directly invested in the portfolio, but you are through the shares that are in the company. But you can see that generally speaking, over most of those time frames, most of those asset classes have done pretty well, and that's a great thing. That means that the portfolio should be doing fairly well. But you will see that in Q2, for example, we have started to see some asset classes doing more poorly. So in shorter term, the performance has come off a little bit. But there is a number of things that are going on, and of course, there's clearly things that are worrying when you pick up the newspaper. Now, typically, I would say that there's three things that are affecting, or the three risks, I suppose, to your money. There's politics, there's policy, and there's protectionism. The three Ps, I suppose. And of course, the first one that everybody thinks about is Brexit. It's all over the news, and it does seem worrying. Ironically, actually, it's probably the thing to worry about least with regards to your investment portfolios. Ironically, if we have a hard Brexit or no deal, then what you'll probably find is that actually the sterling weakens, and that will improve the investment performance you see in your portfolio. So actually, Brexit is of less of worry. And that is also underlined by the fact that Brexit only really affects the UK anyway, maybe Europe a bit, but it doesn't affect the rest of your portfolio. So that for us is less of a concern. Now, when you're reading the news though, just bear in mind that news stands for Negative Events World Service. So, bad news sells newspapers. So just always take what you're reading with a pinch of salt, because there's plenty of positives that are far less highlighted. The US and Donald Trump, clearly that is an interesting worry as well. Now, the US has actually been the strongest performing asset class. It's done extraordinarily well. If you speak to Portfolio Metrics, as we do regularly, you'll know that they find the US market to be overvalued, and they're actually starting to reduce the amount of holdings in the US, which I think makes sense. It's done extremely well, but now looks like a time to take not all of it out of the US, but take some of that risk off the table. There looks like there's going to be some more interest rate rises in the US, but those look to me already priced in. So I think that the US does look a bit overvalued, and so Portfolio Metrics have been tilting the portfolio away from that slightly. There's obviously a whole load of politics going on in Europe, particularly around immigration and also around Italy's debt worries. And it looks like interest rates are going to remain on hold there. But again, this is just a small part of your portfolio. And then finally, the protectionism, the trade wars, this is having an impact on your portfolios, because a strong dollar and these trade wars are definitely hurting emerging markets, and that's what we've seen really come off since the start of this year. So there is some concerns around that, but ultimately there's always concerns. Every year I do this, there's always things that are out there in the market to worry about. And So that's why having a diversified portfolio is so important, because, you know, as they say, if you buy shares in an ice cream company and an umbrella company, you'll do well in any British summer. So let's have a look at how the FTSE's done compared to the rest of the world. Well, you can see actually for most of the year it's done very similarly to the rest of the world. And it's only in the last few months where that gap has opened up. Now, if we look at that over a 20-year time frame, you can see that actually for most of that 20 years, the UK, the FTSE 100, which is the red line, pretty much tracked the world index. And it's only really since 2012 that world index has moved further ahead of the UK. And that could mean that there's more potential for growth in the UK, but it also is a reflection of how well the US has done. The thing is, you're not invested just in the world index, you're not just invested in the FTSE 100, you're invested in a diversified portfolio. So if we go back to December 2013, that portfolio in turquoise is portfolio 5, which on the scale of 1 to 100 is risk level 63. So if you look at your pack, you can see how your risk level relates to that. But the idea is that it gives you growth in the good times. So you can see where the markets are doing well, you're basically growing at roughly the same sort of rate. But when the markets are coming down, yes, you see some falls, but nothing like as extreme. And it's actually in those times where the market is making a correction that you generally find that the outperformance then happens, because it's that protection that the diversified portfolio gives you that allows you to do better in the long run. And let's just have a look at that and over the course of all of the portfolio metrics portfolios. So this is portfolio metrics 1 through to 7. So 1 is 1 out of 100, 7 is 100 out of 100, and 5 stops in between. And you can see the FTSE 100 over the last 12 months came down to quite a significant low and has actually come off again a bit since then. But what you can see is that those portfolios, depending on the level of risk that you're taking, have smoothed that effect, which is really important. And that's why having a diversified portfolio is the best approach that you can have. So yeah, what is going to happen with the market ahead? Well, you know, we don't really know. And I think anybody that says that they do know is worth running in the opposite, or running away from. You know, I think they've said, I've said it before, but economists have predicted 9 of the last 2 recessions. So there's always, there's plenty of media attention to anybody saying that there's going to be a stock market crash. The key is that even Warren Buffett hasn't successfully timed the market every time. And so having a diversified approach is the right way to do it, but it's then picking a level of risk that is right for you and your situation that's also really important. So let's have a look at how portfolio metrics are doing compared to everybody else. And there's 5 ways that we look at their performance. And the first of those is how they're doing compared to their competitors. Because you may say, well, okay, if portfolio metrics have got me 5% growth a year, that seems pretty good. But if everybody else is getting 7%, then I should be fairly unhappy. And equally, if everybody else is getting 3%, I should be fairly happy. And what we want to do is we want to compare portfolio metrics' performance against 2 different worlds. The discretionary manager world, so that's the likes of UBS, Coutts, Investec, all those sorts of guys. And then the fund managers, the likes of Jupiter, Fidelity, Invesco Perpetual, all those sorts of people. And the easiest way to do that is we want to compare the annual growth compared to the level of risk they're taking. And what this chart does is it looks at the growth you've got compared to each level of risk. So the blue line is portfolio metrics. So this is 1 out of 100 on the risk scale. This is 100 out of 100 on the risk scale. This was 63, as I highlighted earlier, which is portfolio 5. The purple line is the discretionary managed world, and the orange line is the fund-based world. And 4 different levels of risk that everybody gets categorized into in those worlds. So what we can see is if we stick with portfolio 5 again, 63 out of 100, over the last 3 years, portfolio metrics have delivered a little under 10% growth per annum. Now that's extraordinary growth. And as I say, you should be really happy with that, subject to not everybody else not getting 12% growth a year. Well, if we went and looked at the average discretionary manager out there, and by the way, the fees for discretionary managers generally are higher than what you're paying portfolio metrics. So these are supposedly the best of the best. the average discretionary manager has been delivering about 6.5% per annum growth over that time frame, and the average fund manager maybe 6.25% growth over that time frame. So over the last 3 years, the performance has been really, really good. But if we look at it over the last year, we can still see actually it's probably even better. The outperformance of portfolio metrics over the last year has probably been even better than it has over 3 years. But even over 5 years, again, looking at that same portfolio, talking about maybe 8.75% growth a year over 5 years compared to 6.25% growth there. So, or 6.5% growth maybe. So the performance compared to their competitors has been very good, and actually this has been reflected in the fact that they've just been shortlisted for top discretionary manager of the year in both growth, which is kind of medium risk, growth aggressive, which is medium high risk, and also of all the smaller firm discretionary managers out there, they've been shortlisted for the top discretionary manager of the year for that as well. Those awards haven't been selected yet, but they're on the shortlist, which is a good start. So we're really happy with what they're doing when we look at them compared to the industry averages. But it's also worth taking some specific competitors that we think are leading guys in the industry to compare them against. So this is the same type of reporting, same annual return compared to risk. This one is 7IM. So Justin Urquhart Stewart with the red braces on, it's on quite often on the BBC. So if you just remember that up and left is good for these charts. We ideally want the most growth possible for any given level of risk. You don't need to look at them all specifically, but so that's 7IM. This one is BlackRock. This one is Close Brothers. This is Jupiter. This is Newton. This is Old Mutual. This is Schroders. St James's Place. Some weird things going on with their risk management. That's really quite worrying. As Standard Life. And what you'll notice of all of those, there was the odd one level of risk that beat the portfolio metrics performance, but generally speaking, their performance has been far better than any of those competitors. And we do this actually for about 35 competitors, so this is just a handful. So we're really happy with what they're doing from a performance point of view compared to their competitors. Second thing we need to look at is your asset allocation. So in your packs, we've done you this chart, and what you'll see on the left-hand side is the target asset allocation we're setting. That's the risk level that's right, that we've agreed with you guys. And then with the current asset allocation is the current split of your investments. Now, these will never look identical, but they should be pretty similar in that. And if there's any wildly different, it's worth just pinging us an email to find out why, and we can have a look at it. Sometimes there'll be a larger chunk of cash than you expect, and that can be because we're just in the middle of it. There's just in the middle of a trade, fund switch or something like that. But generally speaking, they'll never be identical because even if it was rebalanced yesterday, there'll be some market movement. And some assets move quicker than other assets, but they should look pretty similar. And then you've got in your pack the list of all the investments, and again, you'll still see some familiar names like things like the Jupiter European Fund, Fidelity American Special Situations, but then there's also some unfamiliar ones like PIMCO, who manage fixed interest, and Somerset, who have the emerging market, one of the emerging markets funds. Anything with Vanguard or iShares is a passive fund, so that's just following an index that's much lower cost, so it keeps where they're not comfortable with trying to find a fund manager that can beat the index, they'll just put you in the lower cost index. You'll see there's also quite often some US equity is in an index fund as well. Next to the 5 things we need to look at is the growth over and above inflation. What real growth have you had? So this chart, which we'll have done for you, will show you a black line, which for you guys, if you're putting in regular money, will gradually go up, or if you're taking money out, will gradually go down, because it's the money in minus any you've had back. And then the block values behind it will be the value of your investments, and the different colors for you will represent the different accounts. So you'll have maybe one for ISA, one for pension, one for PIP, and junior ISA or anything else that you've got listed as well. The beauty of this chart is that everybody always asks us, how much did I put in and how much is it worth? And this chart gives you that information very easily, in an easily digestible way. So essentially what you've got is that anything above this line is growth over and above what you've put in. So for me, this is one of the most important charts we can give you. Then we break down the account performance. So again, the difference in performance between your ISA, your PIP, your pensions, etc. This will differ in terms of performance because if you start the accounts at different times, then that will impact the performance. But also if you've got different risk levels for different accounts, then again, that will impact it. By the way, if I sound a bit sniffly and bunged up, I'm afraid that's because I am. You want to be glad I'm doing this as a webinar rather than breathing all my children's germs across you in face-to-face. So the beauty of technology. The next page in your review pack, though, is probably the one to focus on a little bit more, in that what we do is we consolidate all the accounts that you've got and we give you the overriding performance that you've had on all the investments. Now, when we set this up for you, we'll have given you a predicted growth level, an expected return level. In this, the example was 3% plus inflation. We assume inflation is going to be 2.25% at the moment, so this would be 5.25% expected growth. But that growth over and above inflation is a really important concept to get your head around, because if we say that you've had 10% growth, that may sound amazing, but if inflation was 12%, you've actually lost 2% of your money. And equally, if you've had 3% growth, that may feel a bit rubbish, but if inflation was negative at minus 2% deflation, then actually you've just had 5% real growth, and that's really good. So this growth over and above inflation is really important. And what you'll see from this chart is two lines. One is the expected growth rate, which on this chart is an orange dotted line. And then you'll see the actual performance experienced. Now, as I said at the start, this is genuine data, and had you invested at the same level of risk as this particular portfolio back in January 2013, you would have seen exactly these returns. So it's quite useful to look at, because what we've seen is 43.5% total growth since inception, whereas we expected, given what inflation has done and how it's varied over that time, we expected 24.5% growth. So that growth is really very good, and we should be really happy with that, because obviously we want to be getting growth over and above inflation at the level we expected, but even better if we're getting faster growth over and above that. And then you'll see here, you've got 1 month, 3 months, 6 months, 1 year. You've also got last 12 months, 12 to 24 months, etc. And then year to date, 2017, 2016. You can see these 2 years produced some really fantastic growth, whereas this year it's been much more subdued, and we're almost flatlining really. Next of those things that we needed to look at was active versus passive growth. So active funds are where we're picking, like the Jupiter European fund that I mentioned earlier, where essentially Jupiter are being paid to try and beat the European market. So you're paying slightly higher fees within that fund to try and beat the European index. Whereas Vanguard, as I pointed out with the US, is a passive fund. So that is where you're paying much lower fees to just literally track the US market. So we want to look each year as to whether the active or the passive approach is better. As it happens, a blend of the two is usually better, but where that blend lies is up to Portfolio Metrics at any one time. As it happens, their best guess approach, what we call the core no-tilt approach, is about 90 to 95% active at the moment, and only about 5 to 10% passive. But that has been down to as much as about 70% active. It just depends on what investments they're picking at the time. Well, what we're saying here is, again, looking at this annual return versus level of risk type reporting. And again, if we pick Portfolio 5 as the example, so this is the fully passive portfolio here, and this is the core approach. Now, most of our clients, we tend to recommend that you go on that core approach, which is their best guess. So most of you will be on that, if not all of you. But what you'll see here is two things. And by the way, this chart is looking after fees. So this is taking account of the fact that this approach is cheaper than this approach. What you'll see, though, is there's roughly 2% per annum additional growth by going into the core approach. So the fund managers of Portfolio Metrics are picking and consistently beating their market over and above the additional fees, which is great. But you'll also notice that dot is to the left of that dot, which means that not only did the active managers picked by Portfolio Metrics deliver you 2% extra growth, what they did was they also reduced the amount of risk you actually experienced, which is fantastic. So that would, for me, say you still need to stay on that core no-tilt approach. If you do happen to be on passive for any reason, maybe you had a preference for it at the start, then you can speak to your advisor about switching that to the core active or core no-tilt approach. So that means that, keeping that approach is still the right thing to do. And then finally, the fifth thing we need to look at is your tolerance to risk, because people's risk does change over time. So let's have a look at how risk has impacted returns and risk. So as I said, we generally look at 7 different portfolios because we know that everybody's somewhere between 1 and 100. So this gives us 5 stops in between to keep looking at. So as you can see, the annual growth has increased consistently the more risk you took, but the more bumpy a ride, the more risk you experienced. Now, sometimes people come to us at the review meeting and say, well, I feel like maybe I should increase risk or maybe I should decrease risk. So it's worth looking at what different portfolio risks look like, just so that you can understand how that impacts your portfolio. So if we had a 20 out of 100 risk portfolio, then you can see that we've now got a huge slug of cash and stable assets. About a third is in fixed interest, so that's medium to low risk investments. So that's loans to governments and loans to companies. And then a bit less than a quarter is in stocks and shares of one form or another. And you'd expect around about 2.3% growth plus inflation. At 40 out of 100, that goes up to 3.1% plus inflation. And we can now see that cash and stable assets has dropped to less than a quarter, and a bit over a third now in bonds of one form or another, and about a third in equities. A bit over a third. At 60 out of 100, portfolio expected growth goes up to about 3.8. And you can see cash and stable assets has now nearly disappeared, and we've started to see property introduced. So worth making a mental note, that's the level of risk that Portfolio Metrics feel that property should feature in your portfolio. At 80 out of 100, then that creeps up further, so we expect about 4.5% plus inflation. Cash and stable assets has gone. Fixed interest is starting to shrink down, and we've got a portfolio that's mostly made up of equities. So it is worth thinking about whether you're at the right risk level for you. Quite often we find that people come into the review workshops, and as they get to understand risk better, they become more comfortable with taking more risk. So if you feel that that's you, then you can scribble that on your recommendations and feedback form, and we can have a look at that for you. Alternatively, as people get older, particularly as they're going through retirement, sometimes they'll want to reduce the amount of risk that they take. So again, this will hopefully help you make that decision. So let's have a look at some changes and some opportunities that are out there. Now, the first thing is that some people like to invest in ethical portfolios that actively screen against companies like, for example, tobacco or companies that make weapons, those sorts of things. If that is something you would like to do, Portfolio Metrics now have a full range of ethical portfolios. Now, generally speaking, investing in an ethical portfolio does increase your level of risk because you're immediately narrowing the pool of investments to pick from and narrowing the funds that Portfolio Metrics can choose from. But it doesn't have to be an all or nothing choice. So, for example, you might say, well, actually, I'd like to do my ISAs as ethical portfolios, but I'd like to keep my pension and my PIP in the core portfolios. So if that's something that is important to you, then it's worth maybe considering having a conversation with your advisor about that, or putting that in your feedback form. One key area for me is pension allowances. Pension allowances are so important. When they created the pension flexibility rules under George Osborne, They made pensions so much more attractive. But since then, what they've also been doing is reducing the amount of money that you can put into them or the money that you can have actually in them. So back when pension freedom was introduced, you could put up to £215,000 each year into a pension if you wanted to. Now that's 40,000, but if you earn more than 150,000, then that comes down to as little as £10,000 a year. So getting money into the pension is actually much more challenging than it's ever been. Now you can go back and use up to the last 3 years unused allowances, as long as you've got sufficient earnings in this tax year to be able to offset. But backfilling those pension allowances is really a great opportunity, because it's so difficult to get enough money into the pensions nowadays. The other restriction on pensions is the lifetime allowance, which is just over £1 million. So really, you want to see that as a target. You want to be using up that £1 million. It's like one massive ISA allowance. As I say, the challenge is getting enough money in there to use it nowadays. But you really want to be using up those allowances. They're far and away the most tax efficient allowance that you've got. You've got the flexibility of accessing the money from between 55 and 57, depending on how old you are. You've got tax-free growth between now and then, and obviously the money's not taxed before it goes in. So they really, really are valuable. Plus, they're extremely friendly from an inheritance tax point of view. So later on in life, they're a great vehicle to have to just hang on to and hopefully leave to the children if you don't need to spend it. But of course, spending it if you do need to. So I'd really try and use that up. If you run your own company, we've also got an increased taxation on dividends. So a good way of trying to offset that is making company contributions into your pension to reduce your drawings through dividends to, again, minimise tax and boost the amount of money in your pension. So I can't emphasise enough how important those pension allowances are. And if you want us to do a carry forward calculation so that we look at how much you can backfill from previous years, then we're more than happy to do that. Because it is a great way of doing it, particularly if you've got good earnings this year. We can offset a significant amount of those from a lump sum pension contribution. Obviously, it goes without saying, your ISA allowances are really important as well. You've got £20,000 each year per person, and these are really valuable. What we want to do is get you to a position where at retirement you've got this good lump of money that's sat in both ISAs and in pensions, because what that allows you to do is draw out a percentage of your income from the pension, which is taxed, so that uses up your tax allowances, and then we can take out the rest from things like ISAs, which are tax-free. So we've got clients where we're drawing over £100,000 a year income for them in retirement, and yet they're paying zero or very little tax, because they've got all the money in the right different pots, and we can minimise the tax as well as possible. So ideally, funding that £20,000 ISA allowance each year is really important. If you've got a PIP with us, then we can sweep money across from the ISA to the PIP, and we've already asked you if you wanted to do that at the start of the tax year. But if we haven't done that yet for you, again, if you want us to do that, we can organise that through the recommendations form that I'm going to come on to later on. If you do have a PIP, which is essentially the same as your ISA, just not in the tax efficient bubble that the ISA is in, then that's growing tax efficiently because it's using up the capital gains tax each year. But even better is if we can try and use up all of the capital gains tax each year, because what that saves you is if in future years you decide to take out a big lump of money, then instead of having a big tax bill to pay, then you might have no tax to pay, because you've essentially been locking down the capital gains tax each year and using up each year's allowance. And we do that in the lead up to the tax year end. So if you've got a PIP, then we'll get in contact with you, but just look out for it again next year. We usually start it in about the start of March, and we'll just need to know what other capital gains you've got, if any, and if you haven't, then we'll make sure that enough switching of funds happens for a 30-day period, then you go back into the original funds just to trigger those gains and use up that allowance. Now, as planning clients, we don't continue to do lifetime cash flow forecasting for you. Now, we may have done lifetime cash flow forecasting as part of your original financial plan, but as planning clients, we don't continually rebuild that lifetime cash flow forecasting. for me, it's one of the most powerful tools that we can do for you from a financial planning point of view. So I just wanted to touch on it and remind you exactly what it is, and also there may be a few of you that have never had one of these. So if you do want to do this, if you are a family client, then we will rebuild this for you each year. So there's two key charts with the lifetime cash flow forecast. First is your income and expenditure, right the way through to age 100. So what it does is it looks at how much income you've got available each year, what your expenses are going to be for each year, and essentially red is bad. So blue is telling us that there's sufficient income for that year. Red is telling us there is insufficient income. So it's telling us that this person is on track to run out of income in their 60s, whereas this person is on track to have enough income right the way through to age 100. Second key chart is what's going on in the background with their investments and savings. So this is showing the total value of their investments and savings during that time. So this person, the guy that was running out of money in their 60s, is running out because they've got insufficient capital and it's all being spent basically. So brown is pensions, yellow is cash, orange is brown is pensions, yellow is cash, orange is investments, so things like ISAs. So this person needs to be thinking about saving more, retiring later, spending less. This person, on the other hand, had sufficient income in retirement, but you can see their assets are actually rising in real terms through their lifetime. So these could be thinking about spending more, retiring earlier, or inheritance tax planning for the future. So lifetime cash flow forecasting for us is really powerful, not just because we can model what you're doing now and say, look, this is what the future looks like if you carry on as you are. We can then start to model what if scenarios to say, well, okay, what if you buy that bigger house? What if you retire 5 years earlier? What if business doesn't go quite as well as you expected? Or what if it goes better and you sell the business for X, Y, and Z? To model all of those different scenarios. And if for our family clients, what we do is in the lead up to the review workshop, we ask them for what if scenarios they want us to model in that year, and we'll remodel those for them each year. So if that's something that you're interested in, it just adds an extra 0.2% onto our ongoing fee. That covers the cost of doing this. And in addition to doing lifetime cash flow forecasting, our family clients get quarterly investment reporting as well. So if that's something you're interested in pursuing and looking at further, then just let us know and we'll happily talk you through that. Another opportunity is relevant life cover. If you run your own limited company, then relevant life cover is a way of putting your own life insurance through the company and getting corporation tax as well as, or corporation tax relief, as well as no benefit in kind taxation on your life cover. So it has the opportunity, spending money on life insurance is the least fun you could probably ever have with your money, but therefore taking 30% of that cost off by putting it through a limited company is a good thing. Can't do it with critical illness cover, but we can do it through life insurance. So if you've got any life insurance that's personal, but you have a limited company that you could do this through instead, then let us know and we will try and look at rebasing that into relevant life cover to save you some quite significant costs. By the way, if anybody's got any questions on any of this, just raise your hand or type a question into the toolbar and I'll try and address them where I can. Another change is to be aware of is something that's happening in the property world. So essentially over the next few years between now and 2021, they're phasing out the ability to offset your mortgage interest against your buy-to-let income. Now we've seen a number of examples where this is taking people from making a nice healthy profit on their buy-to-let portfolios to making quite a substantial loss. And so I really can see this being a problem for the buy-to-let world. And I think we're already seeing quite a few people trying to get out of it. In fact, we've got a client with a 40 property portfolio that wants out of the buy-to-let market at the moment, wants to sell the whole portfolio. And so I would just be cautious about buy-to-let investments. And also if you've got buy-to-let investments, but you're thinking of getting out of them at some point, then I would suggest that you do so sooner rather than later, because I think by 2021, there'll be a lot of people thinking, actually, I want rid of my buy-to-let properties. One financial planning opportunity is what we call the trust framework. Some of your recommendation packs will have recommendations for different types of trusts in them to improve your estate planning. So I wanted to talk you through the main concept of the trust framework. The easiest way to do that is to tell you what's wrong with just having a will. So if I use Carol and I as the example, because it's easier to talk about nasty things happening to me. So bearing in mind we've got two girls, Fiona and Bronwyn, what you would have if we just had a straightforward will is you'd say that if something happened to me, I'd leave everything to Carol, and then on Carol's death we'd want to leave everything to the children, which seems like it makes sense, but actually there's a whole load of problems that can happen. First is that if Carol was to get remarried, let's call him Juan, shall we? Then if she meets Juan and gets remarried and then dies, potentially the girls don't inherit any of our money. Equally, if she gets remarried to Juan and then divorced, maybe half of that money disappears off to Juan. Even if Carol doesn't get remarried, if she ends up in a care home, then everything's in the net for care fees. And as and when she passes away, everything's in the net for inheritance tax purposes. Now that may feel like the end of the problem, but actually there's more to come, because at the moment Fiona and Bronwyn are minors. But if with a straightforward will, they would inherit all of that money age 18, which may lead to an amazing Freshers' Week, but probably not a very good life thereafter. So much better would be to have trustees that could oversee when it was the right time to have that money. And then also, as and when Fiona and Bronwyn meet young men, then if they meet the son-in-law from hell, potentially that money could disappear off again. And again, also, when they come to leave it to their children, we've got inheritance tax to worry about all over again. So there's a whole lot of problems that can happen with just having a will. So what's the alternative? Well, the alternative is what we call the trust framework. And the trust framework can be made up of a number of different types of trusts, and that's why we'll have recommended different trusts to you in your recommendations page, which I'll come on to later on. So how does that work? Well, on first person's death, so on my death, I'd leave certain assets to the trust framework immediately. Typically, that would be any life insurance, it'd be my pension, and it'd also be the first £325,000 of my estate, because that's free of inheritance tax. And that would usually go in the form of being a share of the property. Those assets are made then available to the surviving spouse. So Carol can still spend that money, she can still downsize the house, she can still do exactly the same as she would have done had those been left directly to her. The only difference is there's an IOU sat there in the background that's saying, once you've finished with them, we'd like these assets back, please. So if Carol was to meet Juan and get married and then divorced, or married and died, well, at least we've ring-fenced some of the assets to make sure that they go back to the children, because they're now not part of Carol's estate, they're loaned to her. Equally, if she ends up in a care home, then we've potentially saved some of the property, because that's owned by the trust framework. And with regards to inheritance tax, while this strategy doesn't save much inheritance tax, if Carol was to outlive me by a reasonable period of time, the growth on the money that went into the trust framework on my death would also be free of inheritance tax. So that could potentially turn out to be a reasonable amount of money if there's a significant gap between me dying and Carol passing away. On Carol's passing, then she would leave everything else to the trust. And the reason that she would do that is because that way the girls can then take the money out of the trust framework, again as an interest-free loan. Firstly, if they're still only age 18, the trustees will be saying, well, actually, I don't want to give you all of this money now. I'm going to give you an income maybe because, through university that might be better. But they can make a judgment call. So they might say, well, Theon is actually quite responsible, so I'm going to give her a lump of capital to put as a deposit on a house. They've got the flexibility to manage that in what they think is how we would have wanted. As and when the children, the girls are old enough to take the money out, they can take the whole thing out as an interest-free loan, and they can do what they would have done with that money. But the beauty is, if they are to meet the son-in-law from hell, then again that money is protected because it's not theirs, it's a loan from the trust. And then when they want to leave it to their children, they can just return that money to the trust, and the grandchildren can take that money out again as an interest-free loan. And so whilst I said that we wouldn't save that much inheritance tax between us and Theon and Bronwyn, between us and the grandchildren, we would save huge amounts of inheritance tax, because this we don't end up paying inheritance tax a second time on the same money. So it's really powerful. Everybody always asks, interest-free loan, isn't that a bad thing? Because we've always been programmed into thinking that loans are a bad thing. And generally speaking, that's right, except when what we want to happen with our estate is it to be left to our beneficiaries. And when that loan is essentially to the beneficiaries, it means that less inheritance tax is paid. So for example, if the only thing in Carol's estate on her death was £1 million house, then you'd be paying 40% tax probably on everything over 325,000. Whereas if there is a debt to the trust of, let's say, 500,000, then that needs to be repaid before inheritance tax is calculated. So now we've only got 500,000 in the estate for inheritance tax purposes. So after the 325, which is free, we're now paying only inheritance tax on 175,000, which is significantly less money. So that interest-free loan doesn't stop us spending money in the same way it doesn't stop the children buying houses with the money. It just is a far better way of planning. So what we've quite often recommended in people's review packs, by the way, most of our clients actually have this type of estate planning. So the reason I explain it in the workshops is as a reminder, because quite often people have done it and then they can't remember exactly what they've done. But equally, for those that haven't done it, it's good to understand how it can work. So a beneficiary protection trust is the trust that picks up all of the assets like the house and ISAs and things like that. The asset preservation trust is a trust that picks up the pension. The assurance trust is there for any life insurances, and then business trust is there for business shares. Occasionally some other trusts that we recommend as well, but those are the most common ones that we would suggest that we put into the framework. And by the way, this is also really common planning in the US. It's just that for some reason in the UK, people tend not to do as much of this sort of stuff. Typically the high street lawyers aren't very keen on or aren't very clued up with using trusts as a planning tool, and that's why it doesn't tend to happen so much. Leading on from that is the fact that the inheritance tax threshold got increased by the Tories. It didn't really get increased. They actually introduced a new allowance called the residential nil rate band. This means that it's linked to property, and it can potentially take your total allowances up to £1 million per couple from the 650 it currently is. It is quite a complicated piece of tax, and so again, this type of planning can help ensure that you do benefit from that, whereas it can actually be lost. This residential nil rate band can easily be lost, particularly for larger estates. Also, there is also a type of buy-to-let trust. If you've got buy-to-let properties that you're happy to give up the capital value of, but you want to retain the income from, there is a trust that will facilitate that. It does trigger capital gains tax, so it's not always perfect. But again, that's something that if you want to look at, we can help you with. And while we're on the subject of inheritance tax, one piece of legislation that often gets forgotten about is gifts out of excess income. So you can make gifts out of your regular income. As long as they're regular gifts, then they leave the estate immediately for inheritance tax purposes, i.e. they don't take 7 years like most other gifts do. It's just something that's quite often forgotten. And those gifts out of excess income can be made into trust or direct to the next generation if that's what you prefer. A couple more things to talk about. Firstly, the investor portal. I'm hoping that you've all registered for the investor portal. If you haven't, please, please, please do. We're going to keep pestering you about this thing because increasingly email is a less secure way of communicating. So we really need to be able to send secure messages. We're dealing with huge proportion of you guys' wealth, and we need to be able to communicate with you securely on that. And so secure messaging through the investor portal is really important, as well as giving you all of our important documents online for you in a really one easily managed place. I know it's another username and password to remember. I know that's a bit of a pain, but ultimately it's trying to protect a large amount of money for you. So please do register if you haven't already. If you're struggling with it in any way, get in contact with your client relationship manager and they'll help you get it set up or get the password reset or whatever it is. Hopefully you've seen some emails, but we've done we started doing a podcast. Last one featured portfolio metrics. We get some really positive feedback from these podcasts. Tend to last between 30 and 40 minutes. We've done topics like final salary pension schemes. We've done topics like discretionary investment management. We've done politics, in the impact of politics on your money. And the next one is about protecting your most important asset, which is, of course, you. So look out for those. I hope you'll enjoy those and get some good value out of them as well. I mentioned a minute ago your client relationship manager. So on your review pack, we'll have told you who your client relationship manager is, just so you can put a face to the name. These are the guys that are dealing with that as we speak. So if you've got any questions, these are the people to primarily approach. We've also got a number of financial planners at Efficient Portfolio nowadays. And you will notice that for you guys, the one-to-one advisor meeting is now not usually done by me. I still oversee the advice. I still work with the financial planner to make sure that, because obviously I've been dealing with some of you for a long time. Some of you, of course, weren't ever my clients, but they'll be able to then answer questions, kind of work with you with your specific situation. But ultimately, both of us, you're getting two heads for the price of one. And a lot of these guys are even more technical than I am. So Henry is the new London-based advisor. He's been with us since the start of the year. He's actually a fellow, which means he's basically run out of exams to take. He's an extremely well qualified and good advisor. And then the other names that you'll be seeing are Tom, Tim, and Toby, who are all of our Rutland-based financial planners. Richard, by the way, is Rutland-based as well, but he just looks after his own clients. New for 2017, we bought a mortgage business, so we now do mortgages in-house. We bought Eric Duckworth's business. He's been doing mortgages for over 20 years. Dan, who worked for us, has been giving mortgage advice in a previous role. So Dan is in the process of taking over that business with Eric and learning from all of Eric's experience in the mortgage world. So if you need any help with mortgages, please don't hesitate to drop us a line on that. We can tie that into your financial planning. And the advantage of that is that the left hand knows what the right hand's doing. Quite often where we see people that have got an external mortgage advisor, they'll come back and say, oh, great, I've got this wonderful mortgage and he's arranged it and isn't it cheap? And they'll say, well, yes, but it's a 30-year mortgage and we've built all of your protection around 25 years. And now your protection needs to go up in cost a lot more so than the monthly saving on the mortgage was. So it's about bringing the whole thing together. And so if we can help you on the mortgage, then it's usually a good thing. One other thing is that if you've got accountants and in particular, but also solicitors that you're working with closely, then it's worth then introducing us to them so that we can work more closely with them. Historically, you'd find that the client was sat in the middle getting advice from this trusted advisor over here, that trusted advisor over there, and not necessarily always knowing which way to go because sometimes they conflicted. Whereas much better is that your trusted advisors are all working together and then presenting you the best strategy with all of their expertise. So particularly with your accountant, if you have an accountant, please do introduce us to them and we'll try and work as closely with them as possible to give you the best advice possible. Something that you'll get an invite from, and in fact you should have already had an invite from at some point over the course of the last year, is the Wealth Workshop. This is typically sometimes a half day, sometimes a full day workshop on just some concepts around managing your money better. Now this ultimately is the sort of stuff that we're doing for you, but if you want to learn more about compound growth or tax relief or investment strategy, then this is a way that we can give you better education on that. So by all means, come along to that. We have non-clients at that and we have some clients at it too. So look out for the invites for that. Also look out for details on the referral dinner. We're extremely grateful when you refer us to any other clients and when they go on to become clients, or when you refer us a number of people, whether they become clients or not, we'll invite you to the referral dinner as a thank you. It's a really lovely dinner. This year we did it at Hamilton Hall, which is 2 Michelin star in Rutland, and we did it in Pied de Terre, which is Michelin star in London. Really lovely meals, and it's just a really relaxed evening just to have a chat and enjoy some lovely food and wine. So if you do know of anybody you think would benefit from our help, please do introduce us to them, because if they get they get a benefit, i.e. end up becoming a client, then we'll take you out for a lovely dinner to say thank you. A really easy way of broaching that subject, by the way, is also what's called a dream retirement dinner. So if you've got any friends that you think, well, actually, they may or may not be interested, we host dream retirement dinners regularly as well. We're just about to launch them in London, but we have also hosted them in Rutland. And this is just a really relaxed way. We have, again, a 3-course meal, and I just talk about a concept around, like, for example, financial planning versus financial advice, or the estate planning stuff in between each course. It's a really nice, relaxed, it's not a aggressive sales tactic by any means, but it's a really nice, relaxing way of them finding out a little bit more about us. And obviously, if at the end of that they want our help, then they can do. So if you want to invite people to these events, then please just send us their details and we'll happily get them an invite to our next event. And yes, and the idea being that it's a really nice meal for them to find out more, but if they then go on to become a client, we'll take you out for a really nice meal as to say thank you. And just a couple of other reminders about the benefits they get from you referring them into the business. So they get a free exploration meeting with one of the financial planners at Efficient Portfolio, which is worth £197. They get a third off their initial financial planning fee, which can be sort of another £500 saving. And then also they get the benefit of seeing you at any other events, which, what more could they ask for? So there is nice perks for them as well. In case you're not aware, Efficient Portfolio does have a Facebook page as well. Obviously, I'm on LinkedIn and Twitter as well. But the reason I mentioned the Facebook page is particularly because we post quite a lot of the non-financial stuff there as well. So we'll quite often post TED Talks or interesting articles that we've seen. So if you like and follow us on Facebook, then you'll get a different side to it. It's what we call not necessarily financial. There is some finance stuff in there as well, but it's not all finance by any means. In fact, the majority probably isn't. So do follow us and like us on Facebook too. So coming back to your review pack, there is one of the last pages then talks about your recommendations and changes. We've made a number of recommendations for each of you, and if you could complete that page and return that to us, we'd be really grateful. Just tells us what you do and don't want to follow. If there's anything else that you want us to do for you, then you can make a note in there too. But if you could send us that back, that would be fantastic, so that we can implement the changes that we need to. Now, some of those you'll say, well, actually, I want to discuss with my advisor, which leads me nicely onto the fact that, yes, we also need to arrange your advisor one-to-one meeting, so you can let us know on that form when you'd like to do that. And we encourage you to do that each year, because it's a really valuable period of time, even if it's only half an hour or an hour. It's just talking about what's changed in your life and making sure that the advice is continuing to evolve with you rather than stagnating, as otherwise tends to be the case. And then finally, there is an opportunity to provide some feedback on that form as well. So you can give us feedback as to whether you found this to be valuable, and if all feedback is good feedback. So if you can think of things that we could have done to improve it, then please do let us know. Pretty much leads me to the end of the client review workshop for this year. Anybody got any questions? Anything I didn't cover they expected me to? Anything that they aren't sure about? Please do fire in a question now. I'll just give you a minute or two. If you're going to write a question, but it's going to take a little minute or so, just raise your hand so I know you're about to. There are no hands raised. Okay, that means I've stunned you all into silence, which is fantastic, probably. Well, in that case, it just leaves me to remind you that when you read the papers, don't automatically think what you read is correct, because it could be a duck or it could be a rabbit. Thank you very much. obviously get in contact with your client relationship manager, book your one-to-one meeting with your advisor if we can be of any help. Oh, I do have one question coming in. Just a thank you. Well, thank you very much. Thank you for listening. I hope it's been valuable. I hope it's reassuring that we've obviously had a really good year. I can't promise that it's going to continue always to be this good, but yeah, as long may it continue. So thank you very much. Have a fantastic day, and we'll look forward to hearing from you to get your one-to-one advisor meeting booked in. Thank you very much.